Casinos pocket billions of dollars operating on purely random events, yet retail traders go broke chasing an illusion of certainty. If a single red trade triggers intense execution anxiety, your brain is running on flawed psychological code. Welcome to this explainer. Today, we are going to fix that code. Look, as a professional trader, I can tell you firsthand that the market, it doesn't care about your feelings. It doesn't care about your mortgage or how desperately you just want to be right. We're diving deep into the psychology of consistent success, and we're going to break down the exact mindset shift that separates the casino from the gambler. Let's get to work.
I want you to really absorb that brutal reality check because it diagnoses exactly why so many of you are struggling right now. The typical trader basically just wants to be right on every single trade. You know the drill. You sit down at your screens, you draw your trend lines, and you completely convince yourself you know exactly what the market is going to do next. But the moment the price ticks against you, your heart rate spikes, you start moving your stop loss, or you just freeze entirely. That intense execution anxiety is the ultimate proof that you're trading to prove you're right, rather than actually trading a mathematical system. You're chasing certainty in an environment that literally only offers probabilities.
So to understand how to fix this, we need to look at the ultimate model for profiting from randomness, and that is the gambling industry. The casino profit paradox boils down to a tiny number, just 4.5%. That's the edge a casino typically has over a player in a game like blackjack, based simply on the rules the players have to follow. Now, 4.5% doesn't exactly sound like a massive, insurmountable advantage, does it? The outcome of every single hand of blackjack is completely random and statistically independent from the last one. And yet, day after day, year after year, the casino makes consistent, highly predictable profits.
Let's ground this math for a second to see how that tiny edge translates into a massive empire. Suppose, over the course of a year, players collectively wager, say, $100 million at a casino's blackjack tables. With that 4.5% edge, the casino is going to net a highly predictable $4.5 million in pure profit. They don't need a crystal ball. They don't need to know if the guy in the blue shirt is going to hit or stand on a 16. That average naturally takes into account all the players who walked away big winners, the ones who lost their shirts, and literally everyone in between. Over a large enough sample size, the edge simply guarantees the outcome.
So what exactly is an edge in trading then? Well, it's nothing more than an indication of a higher probability of one thing happening over another. That's it. It's not a guarantee. It is definitely not a prophecy. The analytical tools we use, your moving averages, oscillators, retracements, they just define patterns of collective human behavior that happen to repeat over time. When you finally strip away the illusion that your charts are somehow telling you the future, you realize they're really just putting the odds of success in your favor. It's exactly the same way the rules of blackjack put the odds in favor of the house.
All right, let's move on to Section 1, Micro-Chaos, Macro-Certainty.
Thinking in probabilities requires you to hold two completely contradictory beliefs in your head at the exact same time. It's a mental split, and it takes some real effort to master, but once you do, it completely neutralizes the emotional threat of the market. At the micro level, you must absolutely believe in the uncertainty and unpredictability of every single individual trade. You have to accept that there are unknown variables, like some other trader somewhere in the world placing a massive order, that can instantly turn your perfect setup into a loser. But simultaneously, at the macro level, you have to believe that over a series of trades, the outcome is relatively certain and predictable. You essentially embrace the chaos of the single trade while relying entirely on the certainty of the sample size.
Because casinos don't have to know what's going to happen next, they don't place any special significance, emotional or otherwise, on any individual hand, spin of the wheel, or roll of the dice. Their egos just aren't involved. They don't have a burning, desperate need to be right about the next card. And as a result, they stay completely relaxed. The best, most consistently profitable traders out there use exactly the same thinking strategy. They execute flawlessly because they know a single loss means absolutely nothing to their macro certainty.
Which leads me to ask you a very direct question. Why do you think unsuccessful traders are so obsessed with market analysis? Really think about it. If you intellectually know that the market is random and that any single trade can fail regardless of how incredibly good the setup looks, why do you spend hours staring at 1-minute charts? Why tweak your indicators like they're magic spells, looking for that perfect entry? The truth is, most typical traders crave the sense of certainty that analysis appears to give them. They analyze endlessly, not to actually execute an edge, but to convince themselves they're right before they even put the trade on.
And here is exactly why they do it: the pain avoidance mechanism. Our minds are literally hardwired to protect us from both physical and emotional pain. Being wrong hurts. Losing money hurts a lot. So when a trader desperately wants to be right on every single trade just to avoid that pain, their subconscious goes to work to create certainty where it simply doesn't exist. This mechanism will literally cause your brain to block, distort, or completely diminish the significance of any market data that conflicts with your expectations. You'll ignore a glaring trend reversal, plain as day on the chart, just to avoid the pain of admitting your current position is wrong.
To show you how deeply ingrained this flaw can be, let me share a fascinating anecdote from the source material about a trader named Bob. So Bob was a highly experienced certified trading advisor. He'd been in the business for 30 years and managed about $50 million in investments. Bob was absolutely brilliant at market analysis, but he was stuck. Despite his incredible analytical abilities suggesting he should be seeing returns of around 150 to 200%, he could only ever produce a 12 to 18% annual return. He intellectually understood probabilities perfectly, but he didn't actually function from a probabilistic perspective. His fear of being wrong literally blocked his execution.
Bob's journal entry on his belly trade captures this problem perfectly. He put on a trade in pork bellies and entered a stop loss. The market moved toward a stop, then bounced back to his entry point, where he immediately bailed out entirely out of fear. Almost instantly after that, the market surged 500 points in his original direction, but he was already out. Why? Because putting in a stop loss is not the same thing as actually accepting the risk. Bob didn't genuinely believe the market would trade against him. When it did, he got out with this vindictive, "I'll show you" attitude to punish the market. He hadn't accepted the possibilities, so he couldn't execute his edge.
Let's move into Section 2, the 5 fundamental truths. To fix this whole issue, we need a complete psychological software update. You have to create a mental framework that is totally consistent with the underlying principles of a probabilistic environment. If you want to eliminate the threat of pain, these 5 truths have to become the foundation of your trading belief system. Let's walk through them. Truth number 1, anything can happen, literally anything. 2, you do not need to know what is going to happen next in order to make money. 3, there is a random distribution between wins and losses for any given set of variables that define an edge. 4, an edge is nothing more than an indication of a higher probability of one thing happening over another. And 5, every moment in the market is completely unique. When you fully adopt these 5 truths, your expectations will finally align with the reality of the market, neutralizing that emotional risk entirely.
Which takes us to Section 3, eliminating the emotional risk.
When you accept that every trade is a unique event with a totally uncertain outcome, and at the same time you believe in the predictability of your edge over time, trading actually becomes effortless. You enter a carefree state of mind. You stop trying to predict outcomes. You stop avoiding trades just because you're afraid of losing, and you stop jumping the gun. You just let the probabilities play themselves out. You have to understand that anything you are perceiving now in the market will never be exactly the same as some previous experience. Your mind naturally wants to associate the current setup with the last time you saw a similar pattern, especially if that last time resulted in a painful loss. But the traders making up the market right now, they're different people. Their motives are different. You absolutely must stop bringing the emotional baggage of past trades into the now moment.
And that brings us to the ultimate behavioral difference between the amateur and the pro. In a probabilistic environment, you must be rigid and flexible at the exact same time. A professional trader is incredibly rigid in their rules. They never risk more than their predefined amount, they always honor their stop loss, but they are completely flexible in their expectations of what the market is actually going to do. The typical unsuccessful trader does the exact opposite. They are incredibly rigid in their expectation, they know the market is going up, so they become super flexible with their rules, bending and breaking their risk management just to accommodate that stubborn belief.
As we wrap up this explainer, I want to leave you with one final, absolutely vital question. Look at your recent trading history, think about your emotional state when you are in a position, and ask yourself honestly, are you trading to prove you are right, or are you executing an edge? If you feel stress, anger, or betrayal when a trade goes against you, you are still fighting the math. Embrace the uncertainty, respect the sample size, and let the probabilities do the heavy lifting for you. That is how you finally find your edge. Thanks for joining us for this explainer today, and stay focused out there.